Hello, everyone. Good evening. Tonight, I'd like to welcome you to financial accounting this time. I've done several videos on managerial accounting, mainly in the last couple of weeks. But let's take a turn to financial accounting. Tonight's topic is the preparation of basic financial statements. How do we prepare an income statement, a statement of stockholders' equity, and a balance sheet? I'll not do a cash flow statement tonight. So in this video, I'm going to show you the two steps of the accounting cycle, the trial balance and the financial statements. All right, so we have a trial balance. In my adjusting process video, I've shown you how an unadjusted trial balance is converted into an adjusted one, and how we record the journal entries and how we fill in the blanks, like any changes to the items that we have on an unadjusted trial balance are updated by means of some adjusting journal entries, and that automatically updates our ledger balances that find their places in the adjusted trial balance. So now we have an adjusted trial balance, and let's assume we do. So this is a very small trial balance, with small in the sense that it has only a few items. So you can see it's a trial balance as on October 31st, 2020. But the number of items is not too many. We have cash, accounts receivable, some current assets, some revenues, some expenses, and then some more here. Utilities expense, insurance expense, depreciation expense, and miscellaneous expense. So this is our trial balance. And my task tonight is to convert this, not convert, is to prepare three financial statements: an income statement, a statement of stockholders' equity, and a balance sheet from this trial balance, so based on this adjusted trial balance. All right, so how do you do it? First of all, there is a sequence that must be maintained in the preparation of those three financial statements. The sequence is that you have to do the income statement first. Remember, income statement first, and find the net income, and then plug that onto your stockholders' equity statement or shareholders' equity statement, or in some jurisdictions, they call it retained earnings statement. So the net income, or the bottom line number of the income statement, gets connected to the stockholders' equity statement, goes there, and then the final balances of the stockholders' equity items, like common stock, additional paid-in capital if you have, or share premium in some countries, and retained earnings in particular. So the two most common items of the stockholders' equity statement are the common stock and retained earnings. So we have to find their closing balances, and then those closing balances are transferred to the balance sheet. So this sequence cannot be broken unless you already know the net income or know the closing balances of those equity items. All right. So we assume that you do not, because even if you do, that means you have in some process, in some way in your mind, or in an informal way, you would have done those statements first. So the income statement first, then the stockholders' equity statement, and finally the balance sheet. And if you would like to bring in the cash flow statement here, then the cash flow statement again cannot be done before the preparation of any of these. So we'd need to prepare the cash flow statement, we'd need at least an income statement and two balance sheets, or some additional information based on two balance sheets, one at the end of this year, another at the end of last year, or one at the end of this period, maybe a quarter, and the other at the end of last quarter. So we would need those comparative balance sheets and an income statement in order to prepare the cash flow statement. So that also goes last. All right, so we understand the sequence now. So I'd like to start with the income statement. This is a service company, and by the way, we are going to do a simple income statement first. Simple means a single step income statement, and then in the second half of this video, I do multi-step income statement. So a single step income statement is actually a simple income statement. A single step means that you have all the revenues, or in most cases you'll have maybe two or three items, at best three, but I haven't seen any more than two so far. So you have your revenues, and add that total add the revenue items, and then expenses in one block. All expenses, just throw them in. You don't have to maintain any order, neither alphabetical order nor any order of priority. So in any order you like, you throw in all your expenses and then have a subtotal of the expenses. You have a subtotal of the revenues, then revenues minus expenses, your net income. So that's a simple recipe to prepare an income statement of a small organization or of service organizations. Theoretically, even if the organization is very large, you can still do a single step income statement. There's no problem with that, because and the net income number is going to be the same, whether you prepare a multi-step income statement or a single step income statement. The net income that you calculate is going to be the same. It has to be the same. All right. So and then the same is true for balance sheets. We have two types of balance sheets. We have a classified balance sheet or an unclassified or a simple balance sheet. So first we're going to do a single step income statement. You can see here, this is the name of the company, Net Solutions. This is Warren Jones Tyler textbook from Cengage Publishers. So take a look. 15th edition, by the way, Warren Jones Tyler, 15th edition. And this information is identical to what's in the textbook. So you can see, in other words, the trial balance that I've shown you is directly extracted from Warren Jones Tyler textbook. All right, so we have the income statement here. So the revenues first. We have fees revenue and rent revenue, so other revenue. So the company it's a service organization, as I said. You can see Net Solutions. They do internet services. So they bring fees, so fees revenue, and then their rent revenue. So the two together is total revenue. So the total revenue is 16,960. And then all the expenses here, starting with wages expense, supplies expense, rent expense, utilities expense, insurance, and whatnot. So any expenses you can think of, or any expenses that you can find in the adjusted trial balance must be brought here in any order you like. All right, and then add all your expenses. So that's your total expenses. Here you have total revenue. So total revenue minus total expense is equal to net income. You can have net income before tax and then subtract tax. Then you have net income after tax. So this is a simple and single step income statement. You can see only one step, and we have one notion of income. We just have net income. We don't have operating income or any other form of gross profit or gross income, operating income, net income. We don't have those different types of incomes. We have just one income number, one income metric, which is called the net income before taxes or net income after taxes. All right, so that's our income statement for small businesses, or what do you call a single step income statement. All right, take a look. Bring in all your revenues. If you have just one revenue item, then it's just that one, and then all expense items. But make sure that you only bring the revenues and expenses. Do not bring any assets, liabilities, or equity. And that's why it's very important to understand those 5 elements, isn't it? We need to be able to distinguish between what I call real equity. Remember the 5 elements of accounting? R stands for revenue, E for expenses, A for assets, L for liabilities, and E for equity. So I call them real equity, REAL, equity. Revenues, expenses, assets, liabilities, and equity. All right, so I must assume that anyone who attempts to prepare an income statement knows the revenues or can recognize revenues and expenses in an adjusted trial balance. All right, so that's our income statement. Now the balance sheet. Before we go to the balance sheet, we must see the stockholders' equity section. You can see here the stockholders' equity is here. So we have the common stock, and then retained earnings. Hang on. This is not the. Yeah, here's the stockholders' equity statement. So that was our income statement. Our net income, remember, is $7,105. And now the equity statement of stockholders' equity. All right, now whether it's a small business or large, it is customary to have a column for each of the equity items. As I said a couple of minutes ago, that the most common equity items are common stock and retained earnings. So stockholders' equity statement is actually a matrix type statement. Can you see? It will have columns and rows. Other ones do not. Neither the balance sheet nor the income statement. But the stockholders' equity statement is a matrix statement. Matrix in the sense that you must have the individual columns for the equity items first. So we have two sources of equity, or two forms of equity here. One was common stock and the other one was retained earnings. So let's have the two columns. And then for each column, you start with the beginning balance. Where do you find the beginning balance? You'll find the beginning balance in the trial balance. All right. So bring the beginning balances. And if you don't see it, that means the beginning balance was zero. For example, the net solutions, for net solution, that was the first year of operations. That's why there was no beginning retained earnings in the adjusted trial balance, or in the trial balance that we are that we are using to prepare these financial statements. So the beginning balance of our common stock was zero, and of retained earnings was also zero. And then the company issued common stock of $25,000 this year. So that's why the common stock issued would be found in the trial balance. So for common stock, you'd find the closing balance. For retained earnings, you'd find the beginning balance. So make sure that you know this. Because you might think that, well, Professor, you said that the company's beginning balance was zero. Of course, if you're a new business, then you'd have zero beginning balance of everything. Now, then the trial balance, you have a trial balance means you had some operations, and now we have those closing balances. For retained earnings, though, for retained earnings, you cannot have the closing balance in the trial balance. If you have the closing balance in the trial balance, then it would be a post-closing trial balance. Mind it. So don't get into the complexity of pre-closing or post-closing trial balance, because in an accounting cycle having 9 steps, looks like there are so many steps involving just trial balance. See, an adjusted trial balance, then the adjusting journal entries, then an adjusted trial balance, and now we're talking about a post-closing trial balance. So why so many trial balances? That's a question beside the point here. But what I would like you to know and note is that common stock, even if it's a beginning, it's a new business, you would still have a common stock balance in your trial balance. And that balance is going to be closing common stock, always. New business, old business, existing business, you will have the closing balance of common stock. But for retained earnings, you cannot have the closing balance, even if it's an existing business. You'll have the beginning balance. All right. So in this case, we had beginning balance of zero for both common stock and retained earnings. Then the company issued some common stock, $25,000 worth, and the company didn't buy back any stock or anything. So there was no other change in the common stock column. Only one change, they issued some common stock, so $25,000. So 0 plus 25 makes it 25. And then for retained earnings, there are changes. You can see beginning balance of 0 plus net income. And this net income 7,105 was brought in from the income statement. So you can see this is the connection between the income statement and the stockholders' equity statement. All right, so $7,000 worth of net income. So 0 plus 7,000 minus dividend. That's the formula. Retained earnings, any day's retained earnings is beginning balance plus net income minus dividend. That's how we calculate the current balance of retained earnings. Remember, retained earnings is equal to beginning balance plus net income minus dividend. All right, so our beginning balance was 0. From next year, we're going to have some beginning balance. So even if we had some beginning balance of, say, $10,000, doesn't matter. So that 10,000 plus the net income minus dividend. That's how you calculate the closing balance of retained earnings. And remember, these two, just watch out these two numbers. These two are the important numbers that would be exported to the balance sheet. So this statement, you can see, doesn't have a left or right. There's nothing to balance. It is not like the balance sheet. Can you see? Your goal is to find out the closing balances of all the equity items. And in a moment, you're going to see in a classified balance sheet, you'll see that there's so many, at least 4 or 5 items. There will be common stock, there'll be additional paid in capital, there'll be retained earnings, there will be revaluation reserve, depending on which country you are in. So there could be many more items of the stockholders' equity statement. And the many items you have would all have their individual columns. So if you have 5 types of equity, you must have 5 columns. And for each column, you'd have to start with the beginning balance and then show the changes that happened during the year. So this is also a very comprehensive, informative statement, because this doesn't simply show you the closing balances, unlike, say, income statement and balance sheet. In the balance sheet, we always see is the closing balance, say inventory. You have no way to know what was the beginning balance of inventory, or your goodwill or investments. You have nothing, unless you look at last year's or any prior periods balance sheet. You have no other way to see the dynamics, to see the movement in the item. But stockholders' equity statement is a better statement, and that's why it's a bit intimidating. At this level, it is not, but generally it is. You will have the changes there. So beginning balance plus any increment, any injection of equity, like you might have issued some shares, you might have issued some preferred shares, and while issuing those shares, common or preferred, you would be charging more, like premium. So there would be additional paid in capital, and those additional paid in capital would also keep changing. And then there are, in more complex situation, there will be treasury stock, like the company buys back its own stock, and some of those treasury stock could be retired for forever, and some of those stocks could be held as treasury stock. So there can be changes. But the point for us is that this is a dynamic statement. It starts with the beginning balances and then ends with closing balances. And there's no left or right, so there's nothing to balance. You just have to bring these two. So these two have to be accurate. You bring these two onto your balance sheet. Now, the third statement, or the ultimate statement, is the balance sheet. This is an unclassified balance sheet. You can see it has current assets and property, plant and equipment. So only 2 sections. How many? 2 sections. The balance sheet starts with assets, and some. I don't think I should say that it's unclassified, because there's some classification. But even if you don't do any classifications, that is fine, because now it's more like a classified balance sheet. But no harm. So it's a balance sheet. We have current assets first, and the current assets, there is an order in which you have to present those current assets, and that is in order of liquidity. So the one that's the most liquid is presented first. So cash, of course, is the most liquid. Cash and cash equivalents you'll see in more complex situations. Then there will be accounts receivable, inventory for companies who have inventory. It's a service company, so they don't have any inventory. They have supplies, and they have equipment. Prepaid insurance, and that's all. So that's our total current assets. So we present the current assets, and then property, plant, and equipment, or fixed assets, or non-current assets. They used to be called non-current assets. All right, and that includes land and office equipment, and mine office equipment is netted off its accumulated depreciation. So this company, for example, they have office equipment of $1,800, and this being the first period, the depreciation, accumulated depreciation, is fairly small, only $50. So office equipment minus accumulated depreciation is your closing balance of the equipment, of office equipment. So total PPE is $21,000, and that includes the land and the property, land and equipment, land and the equipment together. So we have current assets and the fixed assets, or property, plant, equipment, and that's our total assets. All right. So that's how you do the asset side of the balance sheet. And now we're going to do the liability side. And this is how you do it. We have the current liabilities. You can see accounts payable, rent payable, anything payable, wages payable, unearned rent, unearned income. So anything that's a liability, you find them on the credit side of the trial balance, and that's your total current liabilities, and then you have the long-term, no long-term liabilities here. But if you do, then bring that in, like loans payable or anything you might have, and then the stockholders' equity, which includes the two balances. You can see we don't need to show the changes here anymore because our stockholders' equity statement already shows the changes. So we just bring the closing balances, and the closing balances of the two equity items are $25,000 and $3,105. That's the retained earnings, and $25,000 was common stock. So the two together is total stockholders' equity, and total stockholders' equity plus total liabilities is total liabilities and stockholders' equity. So that should be equal to total assets. You can see total assets was 29,495, and total liabilities and stockholders' equity is also 29,495. So that's how you prepare these three financial statements. And for my accounting 203 students, this should be enough for chapter 4. When you go to chapter 5 and deal with merchandising firms, companies that deal with commodities and then at advanced level, like in intermediate accounting or advanced accounting, when you deal with larger companies or more complex companies, manufacturing companies, because merchandising is still you buy and sell the same thing. You don't manufacture, so there will be no raw materials, there will be no work in process, and no finished goods. But real companies like say IBM or Toyota or Ford or even Apple, they will have everything with their manufacturing. Apple is a very complex organization. They have services as well as commodities as the products. I mean, they make money from just services like iTunes, and also from their sale of real hardware products. All right, so that's something to look forward to for the future. But for now, for accounting 203, Introduction to Accounting 1 at Alabama A&M, this is what you need to know for chapter 4. And same for my construction management CMG 400 students. Guys, this is how you prepare financial statements. So sit down with your trial balance. Remember, your source document is the trial balance. You use the trial balance information to prepare these three financial statements. All right. Now, in chapter 5, where we do more complicated or more, I would say, larger businesses, we change the income statement, and that income statement is called a multi-step income statement. So this is a multi-step income statement. Multi-step means there will be several notions of profit. There will be several steps. So we get to net income eventually, but we get to that on a step-by-step basis. So the first step is to find out gross profit. So let's calculate net sales. Net sales is your first task. You can see, we can't just say, well, bring in all your revenue, because net sales, just gross sales is not enough. Shareholders or our users deserve to be supplied with a very informative and very user-friendly, informative at the same time, not very complex, not very elusive. It needs to be lucid, it needs to be very readable and understandable. So that's also one of the qualities of useful financial statements. Okay, so net sales, how do you get net sales? Net sales is gross sales or whatever sales information is there, sales minus sales discount and sales returns and allowances. Because companies sell goods, but there are also possible returns or exact actual returns, and there also could be possible returns. So you, in real world, you have to not just estimate or not just account for what's been returned, you also have to include the expected returns as well, the prospective returns. So that's slightly complicated, but for our formula, we just need to know sales minus sales returns and allowances, and also minus sales discount. So once you subtract those two, you get the net sales. So here you can see I started off with $1,000 of sales and my sales returns and allowances and sales discounts together are $30. So if I take it off, I am left with $930 worth of net sales. So keep that in mind, $930. And then we have our net purchases. We would have to find out our cost of goods sold. To get to cost of goods sold, first we need net purchases. You can see less cost of goods sold in red. And how do I get to cost of goods sold is useful. You start with purchases, then subtract like these. You subtract purchase returns and allowances and purchase returns and purchase discount. Because purchase discount reduces purchases, purchase returns also reduces purchases. So that gives us net purchases, you can see, and then add freight in, shipping cost, to bring those purchases in. So once you add freight in, we call it cost of purchases. Net purchases and then cost of goods purchased. You can see we have net purchases here, purchase minus returns and discount, and then after adding freight in, we now have cost of goods purchased, not cost of goods sold yet. And then continue on with cost of goods purchased. You just have to do the inventory adjustments. Inventory adjustments meaning you add beginning inventory and subtract ending inventory. So with net purchases or cost of goods purchased, once you add the beginning inventory, you have cost of goods available for sale. COGS, we call it cost of goods available for sale. So here it is $595 cost of goods available for sale after I added the beginning inventory. And then once I subtracted closing inventory or ending inventory of 210, I'm back to $385 of cost of goods sold. So this is one of the key figures, one of the key information. Cost of goods sold. It has to be subtracted from net sales. So remember how much our net sales was? Our net sales was $970, and now our cost of goods sold is $385. So 970 minus 385 gives you gross profit on sales of quite a lot, $585. This company has a very good gross profit rate, doesn't it? $1,000 of sales and gross profit of nearly $590, $580, so almost 59%. Gross margin. All right, so from gross profit, we have to now subtract the operating expenses. And operating expenses for your convenience or for users' convenience have been classified into two broad categories. One is called the selling. It used to be called selling and distribution. Now most textbooks call it just selling expenses. So selling and distribution is one category, and the other one is general and administrative expenses. So it used to be called SG&A, like selling, general, and administrative expenses together, all together. Selling, general, and administrative expenses. All right, and in like old days, we used to show general and administrative expenses first, and then selling expenses second. But nowadays, we report selling expenses first. So selling first, and then admin. All right, so let's have the selling and distribution ones first. You just have to bring in all sales-related ones like advertising, sales salaries, insurance of salespeople, their traveling expenses, their healthcare, their anything like sales. Sales would involve a lot of equipment, a lot of buildings. So the rent expense, space cost, excuse me, of those facilities, and the depreciation of those equipment, like distribution vans, trucks, lorries, whatever you use, all those assets are deployed to boost sales. So anything that's dedicated to sales or selling and distribution, those costs should be brought in here under selling expenses. So what I have here are advertising, sales salaries, sales commission, depreciation expense of delivery equipment, depreciation expense store building, then insurance expense of sales force and store supplies, etc. And you can also have miscellaneous selling and distribution expenses. All right, so the idea is that accumulate all selling expenses. And then in our case, we had selling and distribution total of say $100. I didn't put specific dollars for individual items, so I assumed all of it together is $100. Now general and administrative expenses, or just administrative expenses, here it will be all administrative type ones. So a company, on the one hand, it has sales force, but it also has other administrative or executive forces. And this would include like CEO pay, everything other than the selling. Could be general and admin. So this includes, for example, legal expenses, professional expenses, insurance expenses, rent expense, depreciation expense of office building, training, repairs and maintenance. I mean, a lot, everything that you can think of. All right. So bring in those items. Salaries expense, so office salaries, admin salaries, even research and development, everything should be brought in here under general and administrative expenses. All right. So the two together is total operating expense. The idea is that these must be operating, so no financial expense, no interest expense should be brought in here. Don't bring in interest expense, at least. Anything that deals with the day-to-day operations of the business. Fuel expense, gas expense, training, all those expenses, but not financing expense. All right. So after you get the two categories of operating expenses, then have a subtotal of the two. That would be a total operating expense, and then subtract it from gross profit. That would give you an operating profit. That gives you the operating profit. So operating profit is a very important metric because that gives you the operating performance sense, a sense of how efficient, how profitable your operations are. Because so far, we have already seen the gross margin. The company had very healthy gross margin, nearly 59%. And now we're going to see their operating margin. The operating profit is 285, so nearly 29% of operating margin. This is also called EBIT, earnings before interest and taxes. EBIT in finance. All right, now after you found the operating profit, now let's look at other items like non-operating expenses and non-operating incomes. So non-operating means, let's say I'm a professor, I teach accounting, so I get paid by the university, I get paid for teaching accounting, but I could have an investment property. So any income I make from my investment property would be other income. That's non-core activity, not my main activity. So we call them other revenues and gains. So these are also part of the business, but not the main business. Okay, like a university could have some investments. A university could make some money from, say, they have some student accommodations that they rent out commercially. So they could have some rental income, or they could have some. A university could have some, say, a research wing that could be other or anything. Well, I think any income from research could be included in sales or total revenue. But university, think of income items that are not related to teaching or research. So I think the best way would be, say, university could have a commercial marketplace, commercial market that they rent out. Like my first university where I went as a student and then worked as a teacher, Dhaka University, we have had a couple of big markets in Dhaka city, and you can imagine rent in Dhaka is like rent in New York. So the university used to make a lot of money from those. So that income would be a good example of other revenues and gains. So bring in other revenues and gains could be like gain on sale of equipment, gain on sale of old assets, gain on sale of shares and investments. So all those items should be under other revenues and gains, and then also subtract other expenses and losses. So like other revenues, you could have other expenses that are not related to your main activity or core activity, and there could be like gains, there could be losses. So the same vein as you can make a gain from sale of an old equipment or gain from sale of land, you could also have a loss from sale of land or loss from sale of investments. So investment could be operating, could be an operational item for a bank or an investment company, but for a university, for example, if they have investments in stocks and bonds, then that would be, or a hospital having an investment in stocks and bonds would be a perfect example of other revenues and gains or other income. And of course, bring in interest. I forgot. So interest income would be here, interest income or interest expense. Because we didn't allow a place for interest income or interest expense in the operating section. So that is going to be here in the other revenues and gains. Would have, if it doesn't have anything, it would have interest income if you have any interest income. Or in the other expenses and losses, if you don't have anything, you'd at least have some interest expenses. All right, so with those two, we now have income from, we call it continuing operations. So these could be other things, but we are still continuing these operations. Here I'm going slightly ahead of chapter 5 of Accounting 203 or Warren Jones Tyler. I'm more into now intermediate accounting, but this is how we prepare a multi-step income statement. You'll have income. We call it income. We're not going to call it net income yet. We're going to call it income from continuing operations. Means this income is likely to be repeated next year, likely to continue year after year. So it has some predictive value. It gives you a good quality financial information. You see? So that's one of the quality metrics, is that information is information, numbers are numbers, but some numbers are useful. Let's say if I tell you say this is my last month of work, or I'm selling my house, and last month I had $3,000 of rent, but from next month that 3,000 is going to disappear. So if I include this 3,000 in my income and give you an impression that my income is X plus, say my salary is X dollars, so X plus $3,000, you'd be excused and you'd be expected to assume that 3,000 is going to be recurring income. I said my income. I used present tense. So to be honest and to be fair with the users, accounting standard setters have asked you. They ask you that if it's discontinued, if I am selling that or have already sold that investment, then I should not show that $3,000 related income in my continuing operations. I should have they have a separate line, a separate section for income from discontinued operations, profit or loss from discontinued operations. And so this is my income from continuing operations, which is 295, and this line is shown before tax and after tax. So income from continuing operations before tax, and then I assume my net income taxes to be $95. This could be an estimate. It doesn't have to be actual. So pay or write down provide for your income tax expense, and then it gives you income from continuing operations after tax. Okay, net of taxes. So that's also a good number, because shareholders and investors and lenders are likely to expect that this number is going to repeat for the foreseeable future. And then we have income from discontinued operations. You can see the next section is income from discontinued operations. So if you have discontinued anything, like we have sold out a whole faculty or a division or a product or an item, then there could be some profit. Let's say we sold some part of our operations, and say a hospital selling one of its campuses or one of its buildings or one of its divisions. So the hospital, Huntsville Hospital, has sold its lab or its cardiac ward, or sold something. So you sold a wing and you made a profit. So that profit has to be reported on an after-tax basis. So show that income from discontinued operations, and then any tax on that, subtract it, and then make it net of taxes. And if you gain anything, if you save anything, if there is a loss, and if you've saved any tax on it, then show that too. So this number is important to be shown on an after-tax basis. It has to be netted off taxes. And then we have the income before extraordinary items. Now, most books have stopped here. They just call it, so they have gross profit, remember, gross profit, then operating profit, then income from continuing operations, and then discontinued ones, and then they say, well, we now have net income. But ideally, there should be another section for extraordinary items. Now, extraordinary items are not other items. Remember, other means these are regular, but not my main thing. Like a professor could be a singer. It's not my day job, but I write poems, or I make some money from singing, and I wish to continue. But extraordinary means, say there was an earthquake, there was a fire, and we had some loss. So shareholders have a right to know this, and companies have a right to show it separately, because if I include it in my regular operations, then my numbers will be depressed, unnecessarily and unfairly depressed. You see my point? Let's say on a regular year, I make $100, I make X dollars. Now this year was not a regular year. This year I had an earthquake, or this year I had major heart operation or major physical procedure that kept me out of work for 9 months. So this is an extraordinary item. This is not going to repeat itself. So companies also like this, that we and users like it, that we show extraordinary items like earthquake losses or war losses or any huge penalty or any huge impairment under this. Remember, restructuring is not extraordinary. Restructuring cost is part of your operating expense. So bring that in operation. Under won't be selling, of course, would be general and admin. So restructuring goes there, but this is more unusual. It must be unusual, infrequent in nature. Okay, so that's extraordinary items. We call it income before extraordinary items, and then the extraordinary items. If there was any net of taxes, and then the net income. Then net income. Of course, if you have errors and changes, or if you have to moderate anything for corrections and errors that you made in previous years, that would be different. But this is our net income, and this net income is shown on a total basis and also on a per share basis, earnings per share, EPS. And as a matter of fact, all these, like we start showing the income from discontinued operations, on a total and earnings per share basis. Because many stockholders, many investors are not, they don't care about your total income. When I make investments, or when I make decisions about investing in your company, I'd like to know your earnings per share, because I can then easily compare it with the stock price and find out your price earnings ratio and other important ratios. So how much you make in total is actually less important than how much you make on a per share basis. Like total income, for example. China's total income is huge, but is a Chinese better off than a Swiss or an Aussie? We don't know. I think we do. Don't we? So the total income is not a good measure, like the total GDP for the whole country. Is not a good measure to see how an individual is doing. So when you're making investments in one share, you want to know earnings per share. And so the EPS information is also standardized. In other words, standard setters have there is actually a whole standard on reporting EPS. All right, so that's our net income. And in today's world, we have comprehensive income as well. So we now need a comprehensive income statement. So that is part of the requirements as well, and part of US GAAP and part of IFRS. The requirement is that you can either have we call it one-story income statement, or a two-story income statement. One story means you have everything in one statement. So you have right from net sales up to net income and EPS and all that, and then add other comprehensive income items, OCI, other comprehensive income. In other words, anything else that changes your equity. It's not it's not part of net income, but it is some unrealized gains and losses. Most of them are of an unrealized nature. So there are 5 actually. Take a look if you can read my handwriting. So these are other comprehensive income items. The first one is written in a very small fonts. Gain or loss from AFS, available for sale securities. Then gain or loss on forex transactions, foreign currency transactions. Then gain or loss on derivatives, on derivative financial instruments. The net unrealized holding gains and losses on investments, holding gains and losses, gains and losses on post-retirement benefits, pension costs, and in IFRS countries, there would be unrealized gain or loss on asset revaluations. Okay? All right, so there could be gains or losses. These are before tax, all before tax basis. And then you have the comprehensive income. All right, so let's say your net income is $100, and then you have unrealized gain on foreign exchange transactions, or on available for sale securities, or on pension costs. Then that could, so your net income could be totally ruined because of these unrealized gains and losses, or it could be boosted because of these unrealized gains and losses. But the important thing is that these are items that change your equity, that do change your equity. So net income also is an equity change measure, isn't it? Net income or income statement is a change statement we call. Net income is the number by which your fate and fortune has changed over this period. If I made $7 in the last 7 days, that means my equity has gone up by at least those $7. Barring the revaluation gains or appreciation of the value of my assets or appreciation of the value of my liability, that would be horrible, isn't it? All right. So now we have the comprehensive income. The bottom line is going to be comprehensive income. So this is how you do a multi-step income statement. Calculate your net sales. Step number 1, net sales. Write it down. Net sales. Sales minus sales returns and allowances and minus sales discount. Step number 2, cost of goods sold. Cost of goods sold. So net sales minus cost of goods sold is equal to gross profit. Okay, do I need to pronounce how to calculate cost of goods sold? So start with your purchases, net it off for purchase returns and allowances and purchase discounts. So you have net purchases, add freight in, you have cost of goods purchased, then add beginning inventory, you have cost of goods available for sale, subtract ending inventory, you have cost of goods sold. So subtract this cost of goods sold from net sales, you have gross profit. Then subtract the 2 categories of operating expenses, you have operating profit. Then bring in other revenues and gains minus other expenses and losses. You have income from continuing operations before tax. Then subtract taxes or estimated taxes. You have income from continuing operations after tax. And then bring in your discontinued, any profit gain or loss from discontinued operations net of taxes. Only gains and losses. The selling price is not what you report here. Selling price is what you report in the cash flow statement. In the income statement, we are interested in whether you made any gain or loss on sale or changes from those discontinued operations. The thing that you discontinued, you might not have sold it, you may have just shut it down. So any money that you made during the year until you shut it down. So any profit, see, even if you sold it, but before selling, you have been using it. It was in operation. So all the operational profit. So if you had a lab, then the lab made, say, $3,000 during the year, and then I made $70,000 of profit. So both of them are going to come here. $3,000 of lab income plus $70,000 of gain from sale of it. Yeah, so I think it was useful to bring that in, because I could be misleading you by giving you the impression, big noise, by giving you the impression that you only bring in the gain or loss from sale of one of your arms. No. It says income from discontinued operations. So any income that you made over the period, and then if you sold it, any profit or loss you made from sale of it, then net everything of taxes, then you report it in the income statement. And then extraordinary items, and then your net income. And then the other comprehensive income items, OCI items, then your comprehensive income. So comprehensive income is equal to net income plus other comprehensive income, plus or minus. Other comprehensive income could be negative. So that's our comprehensive income. Okay. Now, I'm sure you're already tired. I'm older than you, so it's quite normal that I'll be tired too. But just in a moment, I'll just take a couple of minutes of your time. This is a classified balance sheet. I just wanted to show the classifications: current assets, investments, PPE, and intangibles. So I call it CIPI. Current assets, all current assets, cash in hand, cash at bank, even restricted cash. So when you go to intermediate accounting, you're going to see different forms of cash. Restricted cash also comes here. So current assets, like supplies, prepared insurance, prepared expenses. So typical current assets, inventory, accounts receivable. Okay. Then investments, investment stocks and bonds in any other companies, all investments here. Then PPE, land, building, equipment, furniture, appliances, PPE, everything net of their accumulated depreciations. Then intangibles, goodwill, copyright, mastheads, anything, all your intangible assets. So CIPI, current assets, investments, PPE, and intangibles. And then this is the liabilities and stockholders' equity section. So start with current liabilities. I itemize some of those. Current liabilities. Watch for one item. Important is current portion or current maturities of long-term debt. So if you have any long-term liability, that should be reported as a long-term liability in the long-term liability section. But the current maturities, like the amounts that are going to mature within the next 12 months, the amounts that are going to be payable within the next 12 months, that must be reported here. So that's called current maturities of long-term debt. So a good example is, say I have a home loan. So on the home loan, I have a monthly mortgage of say $100 every month. So $100 times 12 is $1,200, isn't it? So do I show $1,200 as current maturities of long-term loan? No, just the principal portion only. So in those $100, in those monthly installment of $100, there could be $30 of principal and $70 of interest. There are usually in America, these installments include four things. They call it PITI, PT, principal, interest, taxes, and insurance. So let's ignore the taxes and insurance for the time being. But if they are included in those mortgages, then exclude those too. Just include the principal component. So the $100 of mortgage payment every month, that's usually like an annuity. They design it in a way that you know your amount of monthly payments. So and it's usually the same amount every month. So $100 of monthly mortgage payments. From each month, from each of those monthly payments, find out the principal portion. So in the first month, maybe you pay only $30 towards your principal. In the second month, of course, by the time some of the say $30 already paid off, so your second month's principal payment could be $31. Although still the total payment is $100, but you would have paid now gradually more and more of the principal and less of interest because your principal balance, your loan balance is gradually declining. So when the loan balance declines, the interest portion also declines. But to keep my payment of, for a uniform amount, the principal repayment keeps going up. Anyway, so whatever that is, that principal portion must be added for all 12 months. And then that should be reported under current liability. That's called current maturities of long-term loan. So just not home loan, if you have auto loan, any form of loan, the amounts that are going to be payable within the next 12 months are actually essentially current liabilities. And again, this is accounting in every step is, standard setters and accountants and companies, everybody is trying to make them as user-friendly as possible. It needs to be to protect investors, to keep accounting alive as a science, as a social science, as an investment aid, as a tool to analyze investments, a tool to aid investment decision making. We need to keep it as user-friendly as possible. So that's what we try to do. You can see here, my total loan could be, say, $300,000. But of the $300,000, maybe only $20,000 is payable within the next 12 months. The total payment is going to be slightly higher or maybe much higher because of inclusion of interest and taxes and insurance. But the principal of, say, $20,000 are going to be paid off in the next 12 months. So my users know that I have some pending, some upcoming, something that's knocking on my door. So that is as good as the current liability. All right. So that current maturity of long-term loan, and then the long-term liabilities, typically bonds payable and bonds and notes payable, long-term notes. So those two, bonds payables and long-term notes payable. And finally, stockholders' equity. Stockholders' equity would come from a stockholders' equity statement, which will have all these individual columns for each one of those. Common stock, additional paid-in capital, you could have preferred stock, retained earnings, and accumulated other comprehensive income, the beginning balance and the changes that happen during the year. All right. So those, all 5 or 4 or however many you have, would be brought in from the stockholders' equity statement. And stockholders' equity statement would be a similar matrix type statement. There would be individual columns, one for common stock, one for additional paid-in capital, one for preferred stock, one for could be additional paid-in capital preferred stock, one could be from like a treasury stock, one would be for retained earnings. Yeah, how can I miss that? Very important one. retained earnings, beginning balance plus net income minus dividend. All right. So the closing balances of all those would make their way to the balance sheet under shareholders' equity portion. So that all the closing balances, so you will have a subtotal here, a subtotal here, subtotal here. So three sections here. I call it CLA, a CLS. C is for current liabilities, L for long-term liabilities, and S for stockholders' equity. CLS. Okay? Not CLA. CLA is a Mercedes-Benz brand. One of their models is CLA, but this is CLS, current liabilities, long-term liabilities, and stockholders' equity. So if you have done everything right, then the total here would be the same as the total here. So that's your classified balance sheet. All right. Now, in a few seconds, I'd like you to think that, what brings in this confidence when someone says that the total here would be the same as the total on the other page. Total assets, assets are totally different set of items than liabilities, different from liabilities and stockholders' equity. Nevertheless, the two totals are the same. They're same because your basis of preparing all these statements is a trial balance, isn't it? And the trial balance was a balanced statement. The total debits and credits are the same. The total of the debit column and the credit column were the same. So if you start with a statement that is already balanced, and then if you know how to post the items onto the three statements, income statement, stockholders' equity statement, and the balance sheet, then you should not have any problem, because let's say you put some items on the credit side of the income statement and some on the debit side. If they're different, then the difference is net income or net loss. So that difference is mitigated because you calculate the difference and then put the difference onto the next statement. Then the closing balance of that statement comes onto your balance sheet. So the net income is the one that mitigates the difference between some revenue items and between revenue items and expense items. So that is an addition to our stockholders' equity. So we bring that extra credit and put it onto the balance sheet, don't we? So our deficiency is already made up. Anyway, the bottom line is that a balance sheet must balance if you have posted everything correctly. All right. Okay, so I hope you have enjoyed the discussions. But even if you have not enjoyed it fully, please try to do the work. Try to follow the steps and try to do your assignments. Try to prepare income statements, stockholders' equity statements, and balance sheets. Try to practice it, because this is going to be the exam, and this is an important takeaway from an accounting course. If you can claim that, yeah, I know how to prepare financial statements, then you have done about almost 25% of your CPA from just one course. So this is an important empowerment tool for you as an accounting student. Anyway, I hope I was able to convince you that this is useful, and I hope to see you in my next video on financial accounting. Have a good night and enjoy your work. Bye-bye.